My name is Deepak Mundra. I am a volunteer at CFA Society India. At my day job, I perform business valuations. We have two more interesting sessions planned. The next session is Be Fearful a Bit When Others Are Greedy by Mr. Rajeev Thakkar. He has about 18 years of experience. Before joining DSP in 2021.
Before we get into the presentation, let me add a word of caution. Chuck Prince in 2007 famously said that while the music is playing, you have to get up and dance. And we are still dancing. What is the context of that? As an organization, if the ethos is that we have to be up with the competition all the time, we have to worry about market share. If other people are lending, we should also be lending to subprime borrowers. And if you or your organization has that ethos, cognitive dissonance in your mind, it is not going to add any value to you whatsoever. So if you are someone who's managing a thematic fund, you don't believe in the theme, but you have to be fully invested at all times, or as Abhishek was saying, if you are going to manage for monthly, quarterly performance, zero value add in this presentation. This is a phrase I have taken from the crypto world. So crypto people are these wonderful people. They'll never argue with you. If you say, how does it make sense buying this hyperlink to that JPEG of some weird looking monkeys at such high prices, they'll say, don't worry, you won't understand. Have fun staying poor. Right? So in equity markets, if you have tried to ask stupid things like, how does this valuation add up? Then you are poorer than your neighbor. So again, if you take this presentation too seriously, have fun staying poor. I know that this is a CFA event, and we don't talk about foolish things like price-earning ratios. All of us are sophisticated people who do DCFs. So please pardon this error. I hope that JC won't report me and make me take my CFA exams all over again. But I'll talk about things which require only division. Numerator, denominator, output. It doesn't require too much of fancy spreadsheet work. I basically have 7 simple points to make in this slide deck. Again, don't crucify me, don't throw stones at me. I am aware that we are in our Amrit Kal, that we will be a Viksit Bharat soon, that China has scored a lot of self-goals, and the entire world has broken up with China, and they are rushing to Indian shores. So we do all these fancy DCFs in our spreadsheet, where we do 30-year, 40-year DCFs. The question comes is, what is long term? Can we justify our year 2000 stock price of 183 rupees split bonus adjusted for Infosys, saying anyway over the long term it is going to give you positive returns. If you hold it for 25 years, it will give you 13% return. DCF will give you a positive number. Do our investors have these kind of horizons, 24 and 25 years? The average mutual fund investor holds her or his mutual fund units for roughly about 2.5 years. That's the number. Some, of course, would be holding longer, but some have an even shorter time horizon. And there's a huge amount of survivorship bias in selection of Infosys as a stock. If instead you held on to DSQ software or Pentamedia or Silverline or something, you would not have even broken even. So the first point that I am making here is that starting valuations matter. Valuation at which you are investing matters. Ravi had this presentation on mega trends, and he covered the full subject matter. What amateurs do is they look at the first 2 or 3 slides and then forget the rest of the presentation, saying, okay, we have to invest in mega trends. Let's go and identify the mega trends. They forget the rest of the presentation that he spoke about. Mega trend would be a necessary condition, but not a sufficient condition. So Infosys was a participant of the mega trend of offshoring of intellectual work from developed countries to developing countries, but you needed to buy it at the right valuation. GDP of China in year 1994 was about $500 billion. That has gone to 17.9 trillion in 23. 24 numbers would be even higher, I would think. So huge amount of GDP growth in the economy of the country. MSCI China has given an absolute dollar return of 20%, not per annum, 20% over 3 decades, less than 1% per annum, right? And probably China is the exception to the rule. It is not. I am not unnecessarily picking on China. You can Google this report from MSCI Bara, and there are various other reports which have tried to look at the correlation of GDP growth in a country with the stock market returns. What they have found is that the linkage is very, very weak. In some cases, they have actually come across negative correlations. So why does that happen? In the study, they have said that corporate profits in a lot of cases have kept pace with the nominal GDP growth rate. However, the EPS has not kept pace. Why is that? To grow profits, companies need to dilute equity. That growth does not come for free. And as a consequence, EPS growth does not keep pace. And again, with globalization, the linkage between countries' GDP growth rate and stock market return breaks down. I'll cover that in a bit detail in future slides. So the second point that I want to make is that the GDP growth rate of India will not bail you out of foolish decisions that you make at the portfolio level. It is a good tailwind to have at best, but don't just rely on India's GDP growing for your portfolio to give you fabulous returns. If you were in mid-90s and you were talking of mega trends, one of the mega trends you would talk about would be the opening up of the civil aviation sector in the country. The second mega trend you would be talking about in mid-90s would be the opening up of telecom sector for private sector cellular mobile companies. This is just a partial list of all the airline companies which went bankrupt. Indigo was not around at that time. It came in much later. And Indigo is probably the only one which has made some money for airline shareholders. Again, a whole host of telecom companies from that era went bankrupt or were acquired. Airtel is probably the only company from that era which made some money for shareholders. So again, getting the mega trend or sector growth right could be a necessary condition, but is not a sufficient condition. A lot of things have to fall in place for you to make money on the mega trend. If at all you revisit Ravi Dharamshi's presentation, go in reverse order. Don't start at the beginning. Look at his later slides first to correct all the misconceptions and then go to the first part of the presentation. The old man who's no longer around, Benjamin Graham, many decades ago in his book, The Intelligent Investor, said this in a beautiful way. He said that obvious prospects for physical growth do not translate into obvious profits for investors. Worth revisiting again and again when we are looking at all the fancy projections that we come across. So the third point I'm making in the slide deck is sector growth may matter less than you think. Obviously, it's better to have a growing company, but with that growth, Ravi said this, Sunil Singhania said this, Pankaj said this, growth has to be value accretive. There are some kind of growth which are value destructive. So just depending on the sector growth to take you forward will not help. Sunil spoke about FMCG companies. So since India is a growing economy, our GDP is going to grow, we will have more and more consumption. So FMCG players in India trade at 60, 70, 80 times earnings. We are also excited about the fact that big box retailers, modern trade as we call them, are coming in. They will take share from Kiranas. So even those should trade at 100 plus P multiples. We are also excited about private labels of modern trade, big box retailers. We are excited about 10-minute delivery. Over there, even earning does not matter. So big box retailers at least have some earning 100 times, 200 times, 300 times. So quick commerce companies are at the early stage of their journey. Earnings also don't matter. All of them are fundraising, whether they are a listed company in the space or whether they are pre-IPO or whether they are at early stage. Everyone is in the money raising stage and everyone is excited about 10-minute delivery. You have 4 to 5 players already and other players are wanting to jump in. We also like the traditional e-commerce players who are upping their game with maybe same-day delivery or 2-hour delivery or 3-hour delivery. Even those get fancy valuations. Government is working on its own initiatives where they want to unbundle the whole e-commerce thing with ONDC. So now you have the ride-hailing companies getting into food delivery and stuff like that. Even those are looking exciting. And finally, every now and then the Kirana lobby makes representations to the government to clip the wings of all these people. Now, somewhere things are not adding up, right? Sunil also pointed this out. You look at the FMCG growth rates from the numbers reported. If private labels are gaining with all these modern trade companies, and if the bargaining power is going to these big retailers, obviously it will be negative for FMCG companies. So somewhere it will be a zero-sum game. It's not that everyone will gain in this space and everyone deserves a 60, 70 times earnings or a triple-digit earnings multiple. Take any high-growth sector that you want. If it's a high-growth sector, if prospects are looking good, other people will want to enter. Before the session, some people were asking me about the stock brokerage space or the wealth management space. A space may be growing, but what does it do to business economics? You would have seen the news headlines of some of the key employees, some of the co-founders of some of these businesses leaving and starting their own competing ventures. So, if a sector is going to double in volume terms in the next 3 years, and if the number of players are going to go 3x, what do you think happens to the growth rates of the companies that you own? So don't assume status quo in the marketplace. If a business is attractive enough, there will be entrepreneurs who will be drawn in to this like a moth to a flame. Keep that in mind. Ultimately, the math should work somewhere. People are very excited by the mutual fund Sahi Hai campaign and all the monthly SIP flows that come in. And till about 15, 20 days back, the popular narrative was that Indian stock market can never go down, no matter what foreigners do or no matter what happens, because with a monthly SIP flow of 20 plus thousand crores, how can the market ever go down? So what is SIP sahi hai for individual investors? Promoters are saying QIP sahi hai. They are going on issuing equity, and these days IPOs are only a small segment of fundraising. Uh, after a company is listed, post 1 year, you have all the lock-ins opening up. So you'll have employees selling, you will have past private equity funds selling, uh, QIPs also happen, rights issues happen. So lot of supply is there. Access Mutual Fund had put out a note where they had estimated around 6 lakh crores of fundraising in the coming 12 months or so. So don't just look at one side of the equation in terms of inflows that are coming in. In any economy, savings and investments will happen at the one end, and on the other side, companies will raise capital to build capacity, to set up all the factories and warehouses and logistics chains and IT services and all of that. Don't just look at one end of the equation. Fund flow itself cannot be a justification for buying overvalued stuff. This issue came to the forefront with one of the IPOs that got listed currently. Valuations in India versus the parent company completely disconnected. In India, you have a company which gets 90% of its profits from global operations. Globally, the valuations are 1/5 of what valuations are there in India. So in this case, should this company get Indian valuations or global valuations? On the flip side, you could have global companies which have substantial Indian operations. What valuation should you give to those companies? Wipro, Infosys, TCS, Accenture, Cognizant, IBM, all of them have very, very similar models. Mylan, Teva, Reddy's, Sun Pharma, all of them have similar models. So, does the country of listing matter in global commodities, in IT services, in generic pharma? What does that have to do anything with India's GDP growth rate or India's demographics or things like that? You should value them on a like-to-like basis. It is a accident that one company is listed here and one company is listed elsewhere. If you are a upstream oil company, what matters is your reserves to production ratio and your efficiency of your oil wells maybe, or the global crude price, which affect everyone equally. Like the movie dialogue goes, "Mere Karan Arjun aayenge," Indians have been holding their breath, "Ke mere FPI aayenge." We have been saying, oh, foreigners are underweight India, they have to keep up with the MSCI weightages. South Korea will soon go away from emerging market index. They are already a developed country. China is uninvestable. Russia is uninvestable. Where will the money go? All the money has to come into India. FBIs have been selling, but strangely, FDI वाले भी जा रहे हैं. people who have listed subsidiaries in India and where they have been owning those companies for decades are finding the valuations attractive enough to reduce their stake in the Indian listed companies and repatriate the money to their home country. And of course, the recent IPO. So the sixth point that I'm making is that in a globalized world, where you are listed does not matter. So, like one of the online travel aggregators which operates in India is listed on NYSE. So, how does that matter? Ultimately, valuation should be comparable across markets, and there has to be some logic to what you are paying. How many people do DCF in this room? Don't feel shy, put your hands up. Sir, what is the discount rate that you use? Cost of equity? 12 to 15%. Okay. Amazing. So this is the number I pulled from Professor Ashwath Damodaran's website on he has a spreadsheet on TCS. 10.63 was the number that was there on his website. I have seen reports where people have had single digit cost of equity numbers in the spreadsheet. Now, that sounds good in a research report, but those people should go and meet some of the mutual fund distributors that are there or some of the stock advisors that are there. On internet, if you Google this thing, 15, 15, 15 rule as if it is a law of physics. This rule states that invest 15,000 rupees every month for 15 years, your money will compound at 15% per annum, and after 15 years, you will have a corpus of 1 crore of rupees. This is almost as if it's equivalent to the speed of light. It will be a constant throughout. So people who are buying mutual funds are probably thinking 15% is a very conservative rate to estimate for equity returns. People are probably coming in with very, very high numbers. And people who are doing DCFs are 10%, 12% kind of thing. So, again, this is a headline that I read. I was not at the event, so pardon me if I'm making a mistake. But Nilesh Bhai, Mr. Nilesh Shah of Kotak Mutual, in a public event said that next 2-3 years, maybe bank FDs will do better than small cap and mid cap returns. So I think there's a disconnect between what investors are expecting and what analysts are putting in their spreadsheets and in terms of their DCF analysis. Yeah, maybe people need a reality check here. This is the seventh point that I wanted to make. This is an old quotation, so may not be very gender appropriate for the current times, but I'll read it for what it is. It is difficult to get a man to understand something when his salary depends on his not understanding it. Right? So if you are that investment banker who's pitching that company to Sunil Singhania, where trailing profits are 35 crores and you want a 7,000 crore market cap, then you deliberately will not understand any of the things that I'm saying. Your salary depends on your not understanding it. And this is the cognitive dissonance that I'm talking about. But a lot of us are CFA charter holders here. We are committed to the code of ethics and standards of professional conduct. Within the market organization's constraints, we should try and exercise diligence, independence, and thoroughness while analyzing our investments and making recommendations and taking investment actions. Have reasonable and adequate basis supported by appropriate research and investigation. These are probably the only three things that, as a minority shareholder, that we can control. Who are the people we are investing with? What is the quality of that business? And what is the entry valuation that we are paying? Nothing else is in our control. Thank you very much.
Rajeev, should we be happy that some of these things are happening as active managers because we can take advantage of this stuff, or there's a threshold level of nonsense or irrationality beyond which it starts hurting us and our investors?
One thing I forgot to mention in the presentation, that if you take this too seriously, there's a severe career risk that people run. And this is not a joke. It's drawn a lot of laughter from the audience. But look at the late 90s. A lot of the renowned asset managers had to shut their funds because of so much of redemptions. .com was happening, and people who were doing sensible investing were losing out and were facing a lot of redemptions. And young people who were throwing caution to the wind and were dancing while the music was playing were doing enormously well. So, how long will your three bosses, if you are a professional investment manager, tolerate your underperformance? So, the three bosses that any investment manager has is, one is your organization boss or the CEO. The second is the intermediary who will advise people on your funds. So this could be a registered investment advisor or a mutual fund distributor or media at large or the portals who track performance. And third is your end client. Any three of them, in most cases, can fire you at will. Now, 1 month, 3 months, 1 year, 2 years, 3 years, how long will people tolerate your underperformance? So, when I gave the title to JC, title of the talk to JC, that time the fall had not started. Yeah. And I was actually prepared for a long winter. And like maybe someday people will just fire me for severely underperforming. And any sensible investment strategy, if you follow that diligently, underperformance of that strategy is a feature, periodic underperformance. It's not a bug. Right. By definition, you will underperform some of the time, unless you are Jim Simons or unless you are Bernie Madoff.
Right. So some of the periods that you mentioned, .com, 2008, was probably a time to be a lot more fearful. And according to a PPFS publication, in 2007, you offered your resignation. Thankfully for us and millions of investors, it was not accepted. Could you just tell us what was the state of mind you were in? And today, if you could speak to that person, what advice would you give him?
Today, that person can probably give me better advice. So, I don't know what inspired that person to, when that person was a nobody and the markets were up 70% and the client portfolios were up 35%. That was the extent of underperformance. So it was not a small underperformance in that sense. And the noise was in an internal meeting. So anyone who was client facing was facing this barrage of questions from clients, and some clients were redeeming money. So the relationship managers were understandably very upset with me at that point in time. So at the end of the meeting with our founder, I had a one-on-one meeting, and I said, I don't understand the companies that are going up. So the infra companies were going up, real estate companies were going up, commodity companies were going up. I said, I don't understand these, and I don't want to do something which I have no conviction in. So I'm happy to step aside and either leave the organization or do something else. It was not that dramatic as it sounds. I said, let someone else run the fund. I'm happy to step aside in that sense. So he said, I have gone through precisely the same kind of situation just 7 years back. So in the late 90s, again, he was not investing in the dot-coms and some of the badly governed companies and overvalued companies. And he was okay with that. So he said, this is precisely what we should be doing. And I'm happy that you are sticking to what you are doing.
I'm amused at some of the questions we get on this, because if you know the history of PPFS, there were periods of almost 8 months where you operated at zero revenues. So this is a firm that had said no to any incremental revenue just to do right by the clients. On my part, embracing Pulak's advice of being very lazy, 2 questions that you put on this very platform to Mr. Prashant Jain. You've mentioned in the past that the incentives of government could be very different from the minority shareholder. They could be thinking of social welfare, they could be thinking of energy security. And another thing that Prashant himself mentioned once was that you should buy PSUs when they are very cheap, and you should sell them when they are just cheap. Today, it would be hard to argue that they are very cheap. Some utilities are trading at higher price-to-book multiple than private banks. How do you think about holdings in this space?
So government is not my favorite partner as a minority shareholder, very clearly. It's not the right up there in terms of the managements that are there. But are they the most egregiously bad managers that are there? Again, they are not. And in terms of their own behavior over a period of time, I think that has improved for the better. Are these great purchases at these times? Answer is no. Are they overvalued? Again, I don't think answer is yes. So some of them are again at 5-6 times dividend yield. You can argue for a 5-7-10% kind of earnings growth.
Right.
So I am okay, unlike some of the presentations that were made. I am okay for a company which has zero payout and which is growing at 15% revenue and profits, and where exit multiple will be similar to the current multiple. I'll still get the 15% CAGR over a holding period. Some other company, if you have a 10% dividend yield and a 5% growth, can still add up to a 15% kind of growth. One example was given, 5 PE stock with zero growth rate, that has an earnings yield of 20%. I am happy owning 5 PE stocks at 20%, 5 PE stocks with zero growth rate, as long as the earning is completely paid out to me.
Right.
So some of these are still reasonably okay. See, finally, one is driven by the environment to a certain extent. Would I be buying these at these valuations in 2020? No. In 24, as compared to where everything else is, do I think these will give me a reasonably positive return above fixed income securities on a 5-year holding period? I think the answer is yes.
So the portfolio is basically, I mean, what you're saying is it's also is dependent on the opportunity set at that point in time.
Yes.
So one question I had is, do you always think in absolute terms, or you're also comparing yourself to the benchmark, to this opportunity set available at the moment? Does your expectations from your portfolio change over time?
Marginally, yes, but not so much. So in a zero interest rate world, did I bring down the valuation requirement so much? No. So in a zero interest rate developed world and in India where let's say 6-7% kind of bond yields, do I say cost of equity is 8%? Answer is no. But in a down and out market, do I look for 20% kind of returns? And in a somewhat expensive market, am I okay with 14-15% returns? Answer is yes. So that kind of calibration does happen.
based on the earnings yield and the interest rate at that point in time.
Yes.
And two people shared their multi-bagger framework. Do you also have a multi-bagger framework that you use? So when markets are down, you're looking at 20% kind of ideas. What exactly are you looking for?
So the concept of the probabilistic and rolling review, that makes sense. So on a first principle basis, we look at equity as owning a business. We look at the kind of promoters that we partner with. Ideally, we would want reasonable amount of growth in the company. And as long as the valuation does not go haywire, we are happy owning things for 5, 10, 15-year periods. And if holding periods are long enough and if company does well enough, you get those multi-baggers on their own. But are we private equity investors? The answer is no. We invest in public markets. So if we have invested in something where we expect to own for 5+ years, and if something happens which causes us to question our hypothesis and the answer is that we should exit, then we do exit without waiting for it to be a multi-bagger. Multi-bagger typically happens if we hold a stock long enough.
They're incidental. Those are not exactly what you're looking for. They happen over time.
I would look for companies to grow significantly. So we obviously look at the size of opportunity and those kind of things.
Right.
But given that we don't want to overpay for a lot of things, the kind of return expectations that people have, I want 25% minimum, I want 30% minimum. I don't think we start with that kind of assumption.
Yeah, and in that case, I always wonder why stop at 25? If you can target a return, why not go to 35? Why not go to 45? And on this holding...
So I'll give you a context where that comes from. This comes from Buffett's statement that if I were managing a smaller sum of money, I could generate 40-50% returns. So people extrapolate that. कि हमारे पास तो पैसे कम है, तो 40-50% तो आना ही चाहिए.
Exactly. We forget that he's Buffett and we are we. On this holding businesses for the long term, the 3 points that you mentioned that we should be careful for, that we'll be careful about when buying businesses. One is starting valuations. Rajeev, as mutual fund investors, we do not have any taxation when we churn our portfolios. So should holding valuations also matter? Do you exit a stock just based on valuations as well? And how do you decide that threshold? Because most investors, value investors, they want large margin of safety when they're buying, but they are okay, slightly more flexible while holding an expensive stock. So how do you get that balance right?
Sure. So I also get the context in which you are asking. So Pulak Prasad had this book coming out where he said, be very lazy while selling and have a very, very long investment horizon. So the structure of something like a PMS or something like a fund that Pulak Prasad runs and an open-end mutual fund structure is different. In a PMS, you handle individual client portfolios. Now over there, it is important that the client has completed 1 year of investing so as not to pay the higher short-term gains. And again, even after 1 year, it is important that the amount of overvaluation is significant enough because otherwise you'll end up paying the 12.5% capital gains tax. Also, the client will be a bit patient. If you have bought something at 100, it goes to 500 and then falls to 400, the client is not going to kill you for that. In an open-end mutual fund structure, what happens is, given that you are open for inflows every day, a client who has bought your mutual fund units yesterday is buying at today's market price.
Right.
It doesn't matter at what price you have bought the stock in the fund. The client is buying all the stocks in that same proportion at the current market price. In which case, we cannot afford to be lethargic in terms of letting overvalued stocks remain for very, very long periods of time. Now, I understand that intrinsic value is a range rather than a point estimate.
Right.
And while selling, we have that leeway. If we are selling on account of valuation, we very rarely have a bullet exit. We typically would tend to sell in small quantities over a very long period of time, gradually reducing the portfolio weightage, so as to account for that we could be wrong even on the estimating the higher end of the valuation. Maybe we are too conservative in terms of valuing the company. So it's a gradual exit when we do on account of valuation. But the approach has to be different for a PMS or a Nalanda kind of fund versus a open-end mutual fund structure.
And a lot of people had this question that how do you think about the factor funds, a lot of passives, smart beta kind of products, and are you also actively using some of these factors for screening, as you said, for exit decisions, for sizing decisions? How exactly are you using these things?
Sure. So I think completely passive funds, factor smart beta funds, and active funds are on a spectrum.
Right.
Passive funds, by definition, saying we'll not apply any logic. We will simply buy the market in terms of the percentage of free float. So whether it's the top 50 companies, top 100 companies, top 500 companies, we will invest in all companies. We don't have valuation filters, governance filters, any other filters. Advantage over there is low cost, arguably low tax incidence. Disadvantages, it can be gamed by a few people, and at extremes, there are some things which can go wrong over there. Smart beta and the factor funds lay somewhere in between. Their promises, we will offer a lower cost than active funds. At the same time, we will replicate some of the strategies which a computer can run instead of having expensive analysts and fund managers running those strategies. There has been a mixed performance in that space, just like in active space. Are there some things which are worth learning from them? Yes. So one is, as far as possible, if you can remove subjectivity and replace that with objectivity, it's always a good thing. Not everything will be able to be quantified, but if you can, it's better to have it quantified. So to that extent, we try and use some of those tools for screening and for our decision making, both on the buying side as well as on the selling side. But we have not automated it completely. So at the end, it's a human making that buy, sell, hold decision.
It's like a smart analyst giving you recommendations, and it's your choice whether to accept it or not, the factor models.
No, so factor models will be like the early warning signals. If a factor model is reflecting probably a buy, then the analyst will see, is there something that we are missing? If the factor model is saying, this does not look that good, and if we are holding it, then we will revisit our assumptions. Is there something that we are missing?
Right. And since you mentioned analysts, Rajeev, as CIO, you probably, I'm assuming the job is evaluating analyst recommendations, evaluating fund manager calls. This is another question that you put to Mr. Prashant Jain, that how do you judge the quality of this decision? Because this is a problem even for the distributors. What he wants to know is, even when fund managers are underperforming, whether he's making good decisions. And in our business, it could be years before the quality of decision is evident. How do you do that?
So to start with, what is the investment philosophy you are subscribing to? Is it something like Masayoshi Son and Vinod Khosla kind of visionary investing? If they are doing that, and if they have a good track record in doing that, and if that is a process and that is what the investor aligns with, by all means, go and do it. And if they are doing what they exactly said at the beginning, stick with them. If your approach is, I will invest in momentum funds, stocks which have done well over a 12-month look-back period, I will invest in those. If they fall below a certain rank, I will exit those. And if you believe that is the way to invest, by all means, go and do that. The only way to judge a person is to see what did they tell you before you invested with them? Have they followed that promise with their actions? And if they have done that, they have done their job. Finally, outcome could be positive, could not be positive. So there's this wonderful book called Thinking in Bets, where the result of any particular play of cards or a coin toss, that result does not matter, the process matters. Now, if we knew for a fact that there is a coin which will turn up heads 70% of the time, the right decision is to bet on heads all the time. Now, you could get 3 tails in a row, doesn't mean your fund management was bad.
Correct.
So, yeah, look at what they have promised, see their actions, do those actions, match their promises.
The only challenge is in investing, the probability distribution itself is not known, so that becomes a challenge.
So I'll tell you that there are very clearly defined things that have worked in the past.
Right.
If that is to your liking, then invest with that. Now, today to argue that Buffett and Munger were flukes and their approach does not work,
Yeah.
it takes a bit of a stretching credibility. They have obviously proven what they do. Or if Rentec has a performance by doing whatever they do, it's a black box. I don't know what they do, but they have a decent enough, long enough track record.
Right. And today itself, we heard it a couple of times that there are multiple ways to heaven, multiple approaches, many ways to skin the cat. But your tagline is there's only one way.
Yeah.
And that is what probably you are referring to. If you look at the history, there is a certain approach that has worked. Could you elaborate why that dichotomy here? Why?
Sure. So a lot of other things, when people talk about, I think they are talking about something which is not necessarily investing. So if your objective is to get certain amount of returns or to increase your NAV, that necessarily does not translate into investing. Investing first principle basis is either you buy equity or you lend money in terms of bonds, and over a period of time preserve capital and grow that capital by way of growth in business profits or from interest income. If you are using tools which predict stock price behavior, then that is not necessarily investing, that is trading, speculation, whatever else you want to call it. So our approach is one approach, and which is what we try and do across.
So one approach to investing, multiple approaches to the pricing game.
Yeah.
Gaurav has a question. What are your current thoughts on the offshore part of your portfolio? And if I can expand that question a little bit, a lot of these companies, they are investing a lot in AI infrastructure. If you look at their incremental ROICs, they are still very, very healthy, but lower than averages. Do you think there is a risk here that everybody is trying to win a certain race at all costs? What are the challenges you see for some of these dominant businesses?
So Abhishek, this worry has come about every 2-3 years.
Yeah.
Right. So at one point in time, like acquisition of a YouTube or a WhatsApp was looked at as a crazy acquisition. And we all know how things pan out. And again, some of these things don't play out. So that acquisition of a hardware company, I forget the name, which made those smart thermostats, that didn't work out as well as expected. So some of these companies have been solving problems which other people are not solving. So arguably that is simpler to do. So I am not probably, it's only part serious, but given that there are only maybe 3 or 4 people attempting to go at self-driving, and where they have vehicles on the road, or where they are trying to do generative AI, I think at the end of the day, again, there will be 3 or 4 players who are dominant in that space, and the opportunities are huge. So return on incremental capital, I think year to year can be very, very noisy. And sometimes you may not even figure out why they are spending so much money.
Right.
But these are, by and large, companies where the founder have huge amount of personal wealth tied up with the company where they are very, very passionate about driving the business, and competition is very, very limited. So I would be fairly okay being invested in those. Uh, Limits have not opened up for foreign investing, so over a period of time, I would expect the proportion of investment in foreign stocks to come down at the portfolio level till the time the limits are increased.
If limits were to open today, Rajiv, are there other segments globally, maybe geographies, sectors that are looking attractive? Given what's happening in India, where the valuations are, if limits were higher, would you be actively looking at that space, and what would be those areas?
We would be looking at definitely investing abroad. Geographies would be North America, Western Europe, developed Asia. We don't want to go to markets where they don't respect minority shareholders, or rule of law is not prevalent, or where there's no English language reporting, or uh, access to information as a minority shareholder is challenging. Uh, by and large, India is a good market to be in, where there were slides which gave a whole host of sectors that are there in India. But there are segments which are missing. So, autonomous driving, EVs, uh, hardware companies in terms of phone manufacturers, or consumer electronics, uh, innovative pharma companies. Some of these segments are missing in India. So, probably we would be investing in those kind of spaces.
Right. Uh, Rajiv, so obviously you want good managements, you want good balance sheets, you want good businesses, and you want them cheap. It becomes like a motherhood statement. At some point, you have to make compromises. At least I judge managers on what are the compromises they are willing to make. Between the two sets of opportunities, one is a very good business available at your assessment of fair value, and the other is not so great business, maybe average business, available at a deep discount to what you consider to be the fair value. How do you pick between these two? Do you allocate certain percentage to certain kind of stocks? What is more attractive to you?
The compromise we have said we will make is short-term underperformance.
Yeah.
So I had the chart of Infosys stock price. Now, after the stock price crash, Infosys remained to be a good company in, let's say, 2002 or 2003 or thereabouts, when the stock price had bombed out. You could have bought it then. So it's not necessary that good companies with good managers remain expensive all the time. So they go through their own cycles, and you have to wait for the right opportunity. So Munger again has put it beautifully. He said, the big money is not in buying and selling, it's in the waiting.
Yeah, but those guys never buy anything. I mean, somebody quoted Apple. Even Apple, they bought at 13xp. So sometimes you might have to wait just too long, which as public money managers, it's difficult to do.
Uh, so a COVID kind of crash will come once in a while, but individual companies,
Can get opportunities.
you get opportunity. Now, people don't agree with me, and our fact sheet is public information, and I've given 2 media interviews today. There are private sector banks which today are available at pre-COVID levels.
Right.
4 years, zero return. But no one believes in them, and maybe they are right, maybe I'm wrong. But saying that companies are always expensive, nahi hai na, real life example hai.
Yeah, I agree with you. Uh, a question on how do you think about some large AI plays, some of the largest companies in the world? Do you think we are getting carried away, or yeah, I mean the return expectation, the dispersion is just too wide? They could be value at this point in time. At this point in time,
So this is such
the
a,
exact name being asked is Nvidia.
okay. I don't have a view on that. So it's a B2B business. I have zero capability in terms of chip design, or what happens. So while NVIDIA chips are very valuable today, are there competitors creating something which could be serious competition down the road? I have no idea. So in the late 90s, we saw this huge boom in the fiber optic companies where people said so much of internet will be used. Definitely people will need so much of optic fiber capacity and so much of routers, and companies like Cisco and all were very popular. Now technology changed and what was once indispensable was no longer so. So
Cisco, I don't think has reclaimed the levels of 2000, if I'm not mistaken. Rajiv, you keep getting the size question. Uh, I wanted to ask, can size also be an advantage? Does it take away whatever little temptation you have to be active? Does it give more resources? Any way in which, or is it just an unmitigated challenge?
I think size is an advantage to some extent, then it starts becoming a disadvantage. Uh, I don't know where we are, whether we are before the peak, after the peak, at the peak, I don't know. Initially, size was a disadvantage. No sell side broker wanted to service us. In fact, one broker actually had put us onto the HNI desk in their team, saying, "ये institution ही नहीं है, this is something like a HNI." Uh, and yeah, now we get sell side access. We can participate in QIPs if we want, and IPOs and all of that. And later on, somewhere it will be a disadvantage. I don't know where.
Last question, Rajiv. Many of us in the industry, including myself, look up to you. Are there active investors in the country who you track, who you try to kind of learn from?
A lot of them are here, presenting here. You are one person we follow, Mr. Prashant Jain, Professor Sanjay Bakshi, plenty of people that are there. So it's a very, very large list.
I'll take that. Thank you for giving us your time and your insights, Rajiv.
Thank you
Thanks.
so much.